So here's a question for you. So what do Lionel Messi, Shakira, and the co-founder of Facebook have in common? Well, their understanding, or I would say the lack of it, of the global taxes on the global tax system. Hopefully after watching this video, you will not be in that same bracket and you'll have a good understanding. Hi everyone, welcome to our channel. In this video, I will try and give you an overview of the global taxes and how this can potentially impact you and also help you towards your journey to financial independence. And hold on, before you say, hey, this is not the video for me, I have nothing to do with the global taxes, be careful. You will have either some form of impact of the global taxes, maybe not now, but in future, if you're on your journey to financial independence. It could be in form of getting RSUs, stock options from the company that you're working for or potentially could be working for in future. It could be you having a foreign assignment or overseas assignment or already on an overseas assignment at the moment. It could be that you have the ambition to send your children for an overseas education in future. Or like us, it could be that you have an ambition to retire somewhere in a different country. So it's important that if you understand this at the moment, it'll help you plan and see how you can minimize your tax impact in future accordingly. So before I get into the details, a quick introduction about myself. My name is Yogi and my wife Seema and I, we both achieved financial independence and we decided to retire early. And during our journey to financial independence, we lived and worked in different countries. And right now, we've chosen to retire in Thailand. So for our entire career and even today, understanding this global taxation has been a very important part of our life. So in this video, I'll try and make sure that I give whatever I can based on our learnings, our experiences, and our successes. So it's not, just to be careful, not a tax advice because we are not tax authority. This is just based on our understanding, our learnings, etc. So let's get started. So the three areas that I will try and give you an overview of and help you understand, first is the taxes itself. What kind of taxes do you have to keep in mind, both for India and both for outside? The second is the tax residency. What does it mean? How does one get a tax residency and how is one not deemed to be a tax resident of one place? And the third is the different types of taxation that different countries use, so that will also help you. So let's start first with the taxes. During our career and during our lifetime, we are impacted with two kinds of taxes. So one is the indirect taxes and the second is the direct taxes. So indirect taxes is in form of GST, VAT, excise duty, etc. So the stuff or the taxes that you pay when you buy any goods and services. Well, if you're on a foreign holiday, you probably have done or are doing right now is comparing a cost of a laptop or a phone or other things and see that how much does it cost if you get the VAT refund at the airport. That means that you're making some kind of a judgment based on the global tax system. But those are, though they are helpful for that holiday, but those are marginal impact that they do. The big impact that happens is the direct taxes. And the direct taxes globally in general would be in 5 types. You pay income tax, you pay capital gains tax, you pay wealth tax. Some countries do have that. And fourth is what many people don't realize and are later negatively surprised is something called exit tax, and I'll come to that in a minute. And the fifth is inheritance tax, that if you have some asset in a country that has an inheritance tax, then what could be the implications? If you're just living, working in India, you may be just focused on the first two, but you will need to start worrying or planning for the other three if you do plan to have some level of global ambition of either investments or residing. Even on the first two, which is income tax and capital gains tax, even there you will have to have a good understanding of what it means globally and how it could potentially impact you. So, for example, you may be working in a company, or you may decide to work in a company that provides you or gives you RSUs or stock options. RSUs, for those who don't know, is restricted share units. And these are awarded by companies with certain achievement of a milestone, and mostly achievement of a time that you spend in that company. So let's just dive a little bit deeper into this RSUs and stock options, because I will try and use this example for explaining the other taxes also. So typically for these RSUs and stock options, there are two very important dates. So one is the grant date and the second is the vesting date. Grant date is when, for example, you joined the company and you've been granted those number of shares. So that day is just giving, the company is giving you a commitment that they will give you X number of shares if you complete certain milestone or a timeline within that company. So just to illustrate this, let's take an example that you join an American company and they grant you 1,000 shares of $100 each. Congratulations, by the way. When you join that company. Now, most likely that the vesting period would be over 2, 3, or 4 years even, but just for simplicity's sake, let's just take 1 year. That you got granted 1,000 shares, $100 each, and they will all vest. And vest means the day those shares hit your bank account. So they are actually yours. From that day onwards, you can sell them, do whatever you like. So let's put 12 months. Now let's take two interesting examples just to show you the impact of that. Let's say that you are working in India and you join this American company in India and you've been granted these 1,000 shares. And within 5-10 days or within a month's time, you have a discussion with your boss, or the company decides to move you to Dubai. And you spend the rest of the next few years in Dubai. What happens is, that means you got granted the shares in India, but they are vesting in Dubai, which is a zero tax country. On the other hand, you are working in Dubai and you join this company and they grant you the same 1,000 shares, $100 each, and within 10 days or a month of joining this company, you decide that you want to go back to India, or because of whatever reasons, you want to take this transfer. And you come over to India, and that means that you were granted those shares in Dubai, but they are vesting while you're living in India. Now, as you can see, they have a very different outcome. For you to be granted in India and you move to Dubai versus you, those shares being granted in Dubai and they are being vesting in India. So just those simple plannings can make an impact on your outcome of your income tax, just as one simple example that I took when it comes to RSUs. Income tax, again, could be on other assets, like you have a passive income. So for example, on the same 1,000 shares, you've been granted these shares, you've got these shares vested, and you're living in India. Now what is going to happen is that you'll get dividends on those shares, and those dividends, most likely the US authorities will, and I'm forgetting the name of this form, W something something, you'll have to fill up, and they will probably either do withholding tax if you are living in Dubai, because what's happening over there is because they are charging you the income tax in the US. Meanwhile, because India has a double taxation treaty, if you are going to be living in India, you will probably write off those taxes in India itself. So those, again, just as an example, the same thing on the issuing, the granting and the vesting, the passive income or the dividends of that, you can see what the impact is on the taxes or the income tax. The same now on the capital gains. Capital gains, by the way, I'm sure you already know, it is the gains that you get on your capital or the growth that you get on capital, and it depends when you cash out of that capital. So there is short-term capital gains, there is long-term capital gains, different tax structure for short-term capital gains and a different tax structure for long-term capital gains. The same shares, let's take an example of that. Now, let's say you got those shares in India, you lived in India, so that means that you completed that 1 year, and what's going to happen on 1 year is that you'll actually physically receive only 700 shares because 300 of those shares out of 1,000, the company withhold it as a tax on the date of vesting. So you'll get those 700 shares of the 1,000 shares that you were granted. Now, let's assume the value of those shares is $100 when they hit your bank account. And over 2 years' time, let's say that the value of the share, the company is doing fantastic, the economy is doing great, goes from 100 to 200, and you decide to sell. So you will have to pay the long-term capital gains. Now let's take another illustration. The same situation that you got those 700 shares into your bank account, and after you got those shares, within the next few days, you decide to move to Singapore. Now what happens is that you move to Singapore and you also transfer those shares into your bank account in Singapore, or they're in Fidelity or UBS or whatever account that the company is keeping those shares in. Now you live in Singapore for the next 1 or 2 years and the same share price goes from 100 to 200. Guess what? Singapore doesn't have that capital gains tax. So from a scenario A, you living in India, you paying taxes on your capital gains, versus living in Singapore, the same shares, you pay zero taxes because there's no capital gains. Again, it could be Singapore, it could be Dubai, or another place that doesn't have capital gains tax. So same example, imagine the difference in income tax that you have. The same example, imagine the difference in capital gains tax. And just by planning accordingly, it can make a difference. And the same scenario, if you put it other way around, that you move from Singapore to India and you move those shares, the same 700 shares at $100, and you live in India for the next 2 years and you sell at $200, you will have to pay capital gains tax from a place where you were not paying. Now moving to the third, which is wealth tax. There are quite a few countries in Europe specifically that charge a percentage of your wealth every year as a tax. So we were living in the Netherlands for a long time, and in the Netherlands, you end up paying almost or up to 2% of your total global wealth to the government as wealth tax. So again, the same example of those 700 shares. Let's say you moved to Netherlands and you had those 700 shares in your bank account. Now what you will need to do is, because that is seen as your wealth, you will have to pay 2% every year of that to the government as a tax of having that wealth. So you can imagine that if you continue having that for 10 years, you will have to pay from that $100 share price to 200 to whatever in future, 2% every year. So again, it has to, you have to do those thinking that what is your total asset. So as you can imagine that the more you get wealth, you will have to be careful of not moving to a country where there is a huge wealth tax. Then comes the next one, which many people are not either aware or do not plan accordingly, and that is the exit tax. Exit tax is the tax that you have to pay in certain countries when you exit out of those countries. So they will put a fair market value on your assets and already charge you gains on those assets when you're moving out of that country. So for example, if you are thinking of moving to some country where you say, hey, what I'm going to do is that I'm going to get a passport over there or get a PR or a permanent resident, and then I have the freedom to travel, and then I come back to India and live over here. Not so fast, because it could be that when you decide to leave that country or emigrate out of that country, they will charge you that exit tax. So one famous or infamous case is of Eduardo Severin, one of the co-founders of Facebook. So he's a Brazilian. He moved to the US, started working there. He acquired the US citizenship. And just before Facebook was supposed to go IPO, he decided to relinquish his US passport to move to Singapore because he preempted that once Facebook goes IPO, and he had, I think, 52 million shares, he decided that he will go to Singapore because Singapore doesn't have capital gains tax. They are a territorial tax system, and I'll come to those different taxations when I talk about that later. And he thought that he's going to save money. And there was a big furor in the US media about this. And there were a lot of articles written. And I think there was some level of out of court settlement between him and the IRS, which is the tax authorities in the US. So people have to be careful and be aware of what the implication is when they leave a country and what could it mean. And the last is inheritance tax. So again, if you have the ambition to buy ETFs, mutual funds, real estate in any other country, make sure that you also understand the laws of the land when it comes to inheritance. Because certain countries, even if you're giving that to next to kin, that you're passing that wealth to your children, you may still have to pay taxes in range of 30 to 40% of the value of the asset. So make sure that you understand the implication of that also. So these are the 5 taxes that you have to really be aware and understand the impact. Then coming the next topic, that is tax residency. So tax residency is generally your status of that, what is your obligation to pay or obey the laws of the land when it comes to taxes. So you're deemed as resident of a country, or tax resident of a country, or a non-tax resident of a country based on certain conditions. Typically, there are 3 types. One is tax residency by the number of days that you stay. The second is the tax residency by an affiliation to the country. And that's an important one. People again underestimate that. And the third is tax residency by citizenship. So US has that very simple concept. That's I think the only country in the world, barring one country in Africa, I think, that if you have a US passport, doesn't matter where you live, you will always be considered a tax resident in the US, that you have to pay certain taxes there. Now, India is in the first category, that is tax residency by the number of days test. So if you spend less than, if you spend more than 183 days outside India in a year, in a fiscal year, then you're seen as an NRI or a non-tax resident or non-resident Indian. Or the other combination is that you've spent less than 365 days over the last 4 years in India, then you're deemed as non-tax resident. Now that's a simple test. Many countries do that. So for example, now that we are residents of Thailand, or planning to live here, here is also the same, that it is that you are, if you spend more than 182 days in this country, you're tax resident, and otherwise not. But be careful, many countries, especially in the developed world, that is most of Europe, Australia, Canada, they check your tax residency not just by the number of days that you are there in that country, but the affiliation to that country. So if you have the ambition that you are going to go and live and work in Canada or in some country in Europe and have your children get the education, get the healthcare benefits, etc., and then you say, hey, when our children are going to college locally, then we will both, husband, wife, go and fire and retire in India. Not so fast, because of your affiliation with the country that your children are still living and studying there, you will still probably be deemed as a tax resident. Now, the famous or infamous case of that was with Shakira, this famous singer. So she's a Colombian. She moved to Spain to live with her boyfriend, the famous footballer Piqué. And she was spending quite a lot of time in Spain. She bought properties there. The Spanish authorities came after her to say, hey, you're a tax resident of our country, and this is the taxes that you have to pay. And she says, no, I'm not a tax resident of Spain because I've spent less than 182 days. And they declared, because of her house, because of her boyfriend living there, even her hairdresser being in Spain, with all these affiliations put together, there was a big lawsuit against her that she had to settle, otherwise she would have gone to jail. So it's not so simple that you just calculate or assume that tax residency is just based on the number of days. So, as I said earlier, if you're planning either to move to a country, to get a passport or a PR in a country, or even to retire or fire in another country, make sure that you understand which country offers you taxes by the number of days and which country offers you taxes by the tax residency, by the affiliation to that country. And the last category that I want to talk about is the different types of taxation that exist, so that you can put these the types of taxes that I talked about, the residency that I talked about, with the taxation systems, so that it can help you put these pieces of puzzles together. So the different types of taxations are: one is the regular global taxation, the second is territorial based taxation, and the third is remittance based taxation, and the fourth, which is the best, is zero taxes or zero taxation. So India is in the first bucket, that if you are a tax resident of India, that means you have to pay income tax on your global income. And you have to pay capital gains also on your global income, because those are the laws of the land. So that's the tax system in India and many other countries, including many countries in Europe, where if you're a tax resident of that country, you have to pay income tax, capital gains tax, wealth tax, inheritance tax on all your global assets, as long as you're a tax resident of those countries. Then there are certain countries that are territorial based taxation. So where you only pay taxes on the income that you derive locally within that country. So anything outside that country, they don't care. Examples are Singapore, Malaysia, where if you are living in Singapore, you're a tax resident of Singapore, and your salary or your income from Singapore would be taxed and subject to the income tax. But your assets outside Singapore in any other country doesn't matter. They don't tax. The third is remittance-based taxation. That is that your income within the country is taxed, but any income that you bring inside the country is also deemed taxable. So they don't care about all your capital gains, all your income outside that country, only the money that you're bringing within that country. Now, this is a new rule, or I would say a new form of taxation. And interestingly, it has been adopted by Thailand, where we've decided to retire. Fortunately for us, Thailand, in that long-term residency visa, has given for the next 10 years at least, that's the duration of our visa, has put us into the territorial-based taxation, so that no income or no money outside that is earned within Thailand is taxable. And the last is zero taxation. That is Dubai and quite a few of those Middle East countries, that there is no taxation as long as you're a local tax resident or deemed as a tax resident of that country. Now, the combination of these become super important, both towards your journey to financial independence as well as during your retirement or retirement early years. So, for example, in our case, we are non-tax residents in India because we are not spending more than 182 days in India. So we are only paying taxes on any earnings that we may have locally within India. So any FCNR or any other deposits, that NRE deposits, they are non-taxable. Similarly, if we have invested in the US market, we've invested through our Singapore bank account onto the US market or international market, They are also non-taxable, not even in Thailand, not even in India, because of the reason that those countries where those investments are, they don't treat those as local tax income. And with our tax residency in Thailand, we are not obligated to file those, or we have the exemption on those assets. So imagine, by just understanding this, we are able to reduce our tax burden, and we are able to use that to fund our retirement early or early retirement lifestyle. So you can imagine how beneficial it can be towards your planning during your financial independence days, so that it helps you during your retirement early days. So in summary, the 5 types of taxes that you need to have a good understanding in the country that you're currently in, and the destination country or the desired places that you plan to live. That is the income tax, the capital gains tax, the wealth tax, the exit tax, and the inheritance tax. Then the second is that you should understand what are the rules of tax residencies in different parts of the world and different countries, and especially what is the rule in the country that is an affiliation based taxation, because that becomes very important, as that is subjective and not just objective. And lastly is, what are the different countries that offer territorial taxation, remittance based taxation, and also zero taxation, so that you can plan accordingly, not just your retirement years, but even your career accordingly. So hopefully this video gives you a fair bit of insight or new information about the taxation, or at least how the global taxation works. Feel free to reach out, comment. If you have any question, do please ask. We'll try our best to answer it. And if you do like the video, please do like and subscribe, and also share it with family and friends. Till the next video, till the next topic, and till the next location, goodbye from me. Bye-bye.